What if I told you there is an indicator that can actually predict where the next swing high or swing low will form before it happens? Not some lagging indicator that repaints after the fact, but a tool that adapts to real market structure and shows you exactly where price is likely to react. Today, I am going to break down one of the most powerful structure-based indicators I have ever tested, the swing structure bands by ChartPrime. And by the end of this video, you will understand exactly how to use this tool to catch high-probability trend continuation trades. Identify key support and resistance zones, and most importantly, how to avoid those false signals that drain your trading account. This is not your typical moving average channel. This indicator thinks differently. It adapts to market swings, detects structure breaks, and only activates when conditions are stable. Stick around because I am going to show you multiple strategies you can implement immediately, including a powerful trend continuation method that has seriously impressive win rates when used correctly. Let us dive in. All right, so what exactly is the swing structure bands indicator, and why should you care about it? Most traders are familiar with channel indicators: Bollinger Bands, Keltner Channels, Donchian Channels. These tools typically use fixed-length moving averages to create bands around price action. And while they work to some degree, they all share the same fundamental weakness. They are static. They do not adapt to what the market is actually doing. The swing structure bands indicator takes a completely different approach. Instead of using fixed-length moving averages, this indicator builds adaptive price bands directly from swing highs and swing lows. In other words, the bands dynamically adjust their length based on how long price has been forming higher highs or lower lows. This allows the indicator to naturally align with real market structure. Think about it. When a strong trend develops, swings become longer and more pronounced. The swing structure bands recognize this and extend accordingly. When price enters a consolidation phase and starts chopping around, the indicator adapts by contracting the bands. This is market-driven intelligence, not some arbitrary fixed parameter. Here is what makes this tool particularly powerful. The indicator continuously tracks three key elements. First, it identifies the most recent swing high and swing low over a configurable swing window. Second, it calculates how long price has been developing since each swing point. And third, it creates dynamic moving averages whose length grows with the swing itself. The creator, ChartPrime, has made this open source, which means you can review and verify its functionality. No black box algorithms, no hidden repaint tricks. Just transparent, structure-based logic that you can test and trust. But the real magic happens when you understand how this indicator visualizes market behavior. The bands do not just show you where price has been. They show you where price is reacting, pausing, or potentially reversing within the broader market structure. And that is the difference between a lagging indicator and a predictive tool. Let me break down exactly how the swing structure bands work under the hood, because understanding the logic will help you use it more effectively. The indicator tracks three core elements that work together to create the adaptive bands. First, swing detection. The indicator identifies swing highs and swing lows using a look-back window. A swing high is detected when price forms a local maximum relative to the swing look-back period. A swing low is detected when price forms a local minimum relative to the same look-back period. This is not rocket science, but it is essential. These swing points become the foundation for everything else. Once a swing point is identified, the indicator tracks something really interesting. It measures how long price has been developing since that swing point was formed. This is what I call swing development time. If price continues making higher highs, the time since the last swing low keeps increasing. If price continues making lower lows, the time since the last swing high keeps increasing. This time measurement becomes critical. Now, here is where the adaptive magic happens. The indicator uses dynamic moving averages. But unlike traditional moving averages that use a fixed period like 20 or 50 bars, these moving averages use a length that grows based on the swing development time. So, if a swing has been developing for 100 bars, the moving average adapts to that duration. If the swing breaks and a new swing begins, the system resets and starts forming new bands from the fresh swing point. You can choose different moving average types: simple moving average, exponential moving average, smoothed moving average, running moving average, weighted moving average, or volume-weighted moving average. Each has slightly different characteristics, but the core principle remains the same. The bands extend and adapt as the market structure develops. The upper bands are derived from swing highs. These act as dynamic resistance during bearish or corrective phases. The lower bands are derived from swing lows. These act as dynamic support during bullish phases. When price is trending strongly in one direction, the bands extend and provide clear visual guidance on where the trend is respecting structure. Now, here's a critical feature that prevents false signals. The indicator includes volatility filtering. If the bands move too aggressively relative to the average true range, they are temporarily disabled. This prevents unstable or noisy bands during sudden price expansions. The bands only remain active when price structure is stable. This is huge because it keeps you out of chaotic conditions where structure breaks down and signals become unreliable. When price transitions from forming highs to forming lows or vice versa, the direction flips. The system recognizes this and resets to start forming new swing-based bands. This is not repaint, it is adaptive structure recognition. And each confirmed swing is marked directly on the chart, giving you clear structural context. Let me walk you through what you are actually seeing on the chart when you load this indicator, because understanding the visual elements is essential for practical trading. The most prominent features are the upper and lower bands. The upper band is typically displayed in purple or magenta. This band is derived from swing highs and represents dynamic resistance. When price is below this band and moving downward, it acts as overhead resistance. If price approaches this band during a bearish move, you can expect potential reaction or reversal. The lower band is displayed in green. This band is derived from swing lows and represents dynamic support. When price is above this band and moving upward, it acts as underlying support. If price pulls back toward this band during a bullish move, it is often a high probability continuation zone. Now, between these two bands, you will notice shaded areas or fills. This visual fill helps you quickly assess the width of the current swing structure. A wide band suggests an extended mature swing. A narrow band suggests early swing development or consolidation. On the chart, you will see labeled markers for swing highs and swing lows. A swing high label appears in purple or magenta and typically says swing high. A swing low label appears in green and says swing low. These labels mark confirmed swing points, and they are absolutely critical for your trading decisions. I will explain why in a moment. You will also notice rectangular boxes on the chart. These are visual signals. The green rectangles appear when price crosses up from the lower swing band after sufficient stabilization. The purple rectangles appear when price crosses down from the upper swing band after sufficient stabilization. These rectangles are your primary entry signals when used correctly. One thing you will notice is that the bands do not appear during every single bar. If the market becomes too volatile or if there is a structure break, the bands temporarily disappear. This is the volatility filtering at work. It is keeping you out of bad conditions. When the bands reappear, you know structure has stabilized again. Each confirmed swing is clearly marked on the chart. This provides you with clean structural context. You can see at a glance whether price is forming higher highs and higher lows or lower highs and lower lows. This is incredibly valuable for understanding the bigger picture trend. The indicator does not clutter your chart with unnecessary information. It focuses on what matters: structure, swings, and reaction zones. This clean visual presentation makes it easy to interpret even during live market conditions when you need to make fast decisions. Now let us get into the practical stuff. How do you actually trade with this indicator? I am going to show you multiple strategies, starting with the most powerful one. This is the strategy I personally find most effective, and it is the one ChartPrime recommends as the primary use case. Here is the rule set. You buy at green rectangle signals, but only after a swing low label has appeared on the chart. You sell at purple rectangle signals, but only after a swing high label has appeared on the chart. This is a trend continuation strategy. Why does this work so well? Because you are not trying to catch reversals or pick tops and bottoms. You are waiting for the market to establish a clear swing direction. then you are entering on pullbacks within that established structure. Let me walk through both sides. For long entries, here is what you are looking for. First, the market forms a swing low. This is confirmed by the swing low label appearing on your chart. This tells you that price has found a temporary bottom and is beginning to develop upward. Now you wait. You do not enter immediately. You wait for price to pull back toward the lower green band. When price crosses up from the lower band and a green rectangle appears, that is your entry signal. You are buying into established bullish structure on a pullback. This gives you excellent risk reward because you are entering near support within a confirmed uptrend. Your stop loss goes just below the recent swing low. Your take profit can target the upper purple band or a previous swing high, depending on your risk-reward preference. Many traders use a 2-to-1 or 3-to-1 risk-reward ratio with this setup. For short entries, the logic is inverted. The market forms a swing high, confirmed by the swing high label. This tells you that price has found resistance and is beginning to develop downward. You wait for price to pull back toward the upper purple band. When price crosses down from the upper band and a purple rectangle appears, that is your entry signal. You are selling into established bearish structure on a retracement. Your stop loss goes just above the recent swing high. Your take profit can target the lower green band or a previous swing low. This strategy works on all time frames, but it tends to perform best on higher time frames. Like the 4-hour or daily charts where swings are more reliable and noise is reduced, the key is patience. You must wait for swing confirmation. If you jump into every rectangle signal without checking for swing labels, you will get chopped up in consolidations. Here is another powerful way to use this indicator. Treat the bands as dynamic support and resistance zones and combine them with higher time frame trend direction. Start by identifying the higher time frame trend. Go to the daily or weekly chart and determine if the market is in an uptrend or downtrend. Then drop down to your trading time frame, let us say the 1-hour or 4-hour chart. Use the swing structure bands to identify key reaction zones within that higher time frame trend. In an uptrend, the lower green band becomes your primary support zone. When price pulls back to this band, you look for bullish confirmations like bullish engulfing candles, hammer patterns, or bullish divergence on momentum indicators. These confirmations increase your probability of success. You are not blindly buying the band, you are looking for confluence. In a downtrend, the upper purple band becomes your primary resistance zone. When price rallies to this band, you look for bearish confirmations like bearish engulfing candles, shooting star patterns, or bearish divergence. Again, you are stacking probabilities in your favor. The beauty of this approach is that the bands adapt to changing conditions. If the trend accelerates, the bands extend, giving you new dynamic levels. If the trend slows or enters consolidation, the bands contract, telling you to reduce position size or step aside entirely. Here's another strategy for you. This is a variation of strategy 1, but with an extra layer of confirmation. You combine the swing structure bands with another indicator like the relative strength index, moving average convergence divergence, or a simple exponential moving average. For long trades, you wait for a swing low label, then you watch for price to pull back to the lower green band. But before entering on the green rectangle signal, you check your confirmation indicator. If you are using RSI, you want to see it bouncing from oversold or showing bullish divergence. If you are using MACD, you want to see a bullish crossover. If you are using an exponential moving average, you want price to remain above it. This extra confirmation reduces false signals and increases your win rate. The trade-off is that you will take fewer trades, but the trades you do take will have higher probability. For short trades, you wait for a swing high label, then watch for price to pull back to the upper purple band. Before entering on the purple rectangle signal, check for bearish confirmation. RSI showing overbought with bearish divergence, MACD showing bearish crossover, or price remaining below a key exponential moving average. This layered approach is excellent for conservative traders who prioritize accuracy over frequency. You are not trying to catch every move. You are trying to catch the best moves with the highest confidence. Not all market conditions are created equal, and the swing structure bands perform best in specific environments. Let me tell you when this indicator shines and when you should be cautious. The indicator works best in trending markets with clear swing development. When a market is trending, either up or down and forming distinct higher highs and higher lows or lower highs and lower lows, the swing structure bands are in their element. The bands extend cleanly, the swing labels appear regularly, and the signals are reliable. These are the conditions where you want to be aggressive with your position sizing. Another ideal condition is markets transitioning from impulse to correction. When a strong impulse move occurs and price begins to correct or consolidate, the bands adapt beautifully. They show you exactly where the correction is likely to find support or resistance before the next impulse. This is prime real estate for trend continuation trades. The indicator also performs well in crypto, forex, indices, and liquid stocks. It does not matter what asset class you trade. As long as the market has sufficient liquidity and clear swing structures, the indicator works. I have personally tested it on Bitcoin, Ethereum, major forex pairs like EUR/USD and GBP/USD, and stock indices like the S&P 500. The results are consistent across all these markets. Now let me tell you when to be cautious. Low volatility, tight range markets are not ideal. When price is chopping sideways in a narrow range and there is no clear swing development, the bands will contract and potentially disappear due to the volatility filter. This is actually a good thing because it is telling you to stay out. But if you ignore this signal and try to force trades, you will get stopped out repeatedly. Another challenging condition is during major news events or sudden volatility spikes. If a Federal Reserve announcement, earnings report, or geopolitical event causes price to gap or spike violently, the bands may temporarily disable or give false signals. The volatility filter helps, but it is not perfect. My advice is to avoid trading around high-impact news events regardless of what your indicators are telling you. Finally, be cautious in extremely thin or illiquid markets. If you are trading a low-volume altcoin or a penny stock, the swing structures can be erratic and unreliable. The indicator is designed for markets with healthy liquidity where swing points represent genuine supply and demand dynamics, not manipulation or lack of participation. While the swing structure bands are powerful on their own, combining them with complementary tools can significantly improve your trading results. Here are some combinations I have found effective. First, combine with a momentum oscillator like RSI or stochastic. The bands tell you where price is reacting structurally, but they do not tell you whether momentum is increasing or decreasing. Adding an oscillator gives you that extra dimension. For example, if you get a green rectangle buy signal at the lower band, and RSI is bouncing from oversold, that is a much stronger signal than the rectangle alone. Second, combine with volume analysis. Volume confirms the validity of swing points. If a swing low forms on high volume, it indicates strong buying interest at that level. If a swing high forms on high volume, it indicates strong selling interest. When you enter on a rectangle signal and volume confirms the swing, your probability of success increases. You can use volume indicators like on-balance volume, volume-weighted average price, or simply look at the volume bars directly. Third, combine with multi-timeframe analysis. Use the swing structure bands on your trading timeframe, but always check the higher timeframe for overall trend direction. If the daily chart shows a clear uptrend and your 4-hour chart gives you a green rectangle buy signal, that is alignment. If the daily chart shows a downtrend and your 4-hour chart gives you a green rectangle buy signal, that is divergence and you should be more cautious or skip the trade entirely. Fourth, combine with key horizontal support and resistance levels. The bands show you dynamic structure, but horizontal levels show you static structure where price has historically reacted. When a green rectangle signal appears at the lower band and that level coincides with a major horizontal support zone, you have confluence. The same applies for purple rectangle signals at horizontal resistance. Finally, consider combining with a simple trend filter like a 200-period exponential moving average. If price is above the 200 EMA, only take long signals. If price is below the 200 EMA, only take short signals. This keeps you trading with the dominant trend and filters out counter-trend trades that have lower probability. The key with combinations is not to overcomplicate your chart. Pick one or two complementary tools that add value without creating confusion. More is not always better. Clarity is better. Let me save you some pain and money by pointing out the most common mistakes traders make when using the swing structure bands. Mistake number 1. Taking every rectangle signal without waiting for swing confirmation. This is the biggest killer. If you see a green rectangle and immediately buy without checking if a swing low label has appeared, you are gambling, not trading. The swing labels are there for a reason. They confirm that structure has been established. Without that confirmation, you are entering random pullbacks in random markets. Wait for the swing label. Be patient. Mistake number 2. Ignoring the volatility filter. When the bands disappear from your chart, that is not a malfunction. That is the indicator telling you conditions are not stable enough for reliable signals. Do not try to force trades when the bands are disabled. Step aside and wait for them to reappear. This simple discipline will save you from countless losing trades. Mistake number 3, using the indicator on time frames that are too low. If you try to use this on the 1-minute or 5-minute chart, you are going to get a lot of noise. Swing structures on very low time frames are less reliable because they are heavily influenced by random fluctuations and market noise. Stick to the 15-minute chart or higher. The 4-hour and daily charts are ideal for most traders. Mistake number 4, not using proper risk management. Just because you have a high-quality indicator does not mean you can ignore position sizing and stop losses. Every trade should have a clearly defined stop loss just beyond the swing point. Every trade should have a target that gives you at least a 1-to-1 risk-reward ratio, ideally 2-to-1 or better. Never risk more than 1 to 2% of your account on a single trade, regardless of how confident you feel. Mistake number 5. Trading against the higher time frame trend. If the daily chart is in a strong downtrend and you take a long signal on the 4-hour chart, you are swimming upstream. The probabilities are against you. Always align your trades with the higher time frame trend. Use the swing structure bands to time entries within that trend, not to fight against it. Mistake number 6. Over-optimizing the settings. The default settings are designed to work well across most markets and timeframes. If you spend hours tweaking every parameter trying to find the perfect setting, you are curve-fitting to past data. Keep the settings simple. Focus on execution and risk management instead. And finally, mistake number 7. Expecting perfection. No indicator is right 100% of the time. Not this one, not any other. You will have losing trades. That is part of trading. What matters is that your winning trades are larger than your losing trades, and that you maintain positive expectancy over a series of trades. Do not abandon the strategy after a few losses. Give it time to work over a statistically significant sample size. All right, let me bring this all together and give you my final thoughts on the swing structure bands indicator. This is genuinely one of the most intelligent structure-based tools I have used. The fact that it adapts to real swing behavior rather than relying on fixed parameters makes it far superior to traditional channel indicators. The volatility filter ensures you are only getting signals when conditions are stable. The swing labels provide clear structural context, and the visual presentation is clean and easy to interpret. The trend continuation strategy, where you wait for swing confirmation and then enter on rectangle signals, is particularly powerful. It keeps you trading with the trend, gives you clear entry points with favorable risk-reward, and eliminates a lot of the guesswork that plagues most traders. If you only use this indicator for that one strategy, it will be worth it. But the versatility is what really impresses me. You can use this for trend continuation, dynamic support and resistance, reversal trading, or as a structure framework combined with other indicators. It works across multiple asset classes and timeframes. It is open source so you can verify the logic. And it does not repaint, which is absolutely critical for backtesting and live trading. Now, I want to be realistic with you. This is not a magic bullet. No indicator is. You still need to understand market structure, risk management, and trade psychology. You still need to put in the work to backtest, paper trade, and develop your own trading plan around this tool. The indicator gives you an edge, but it is up to you to execute that edge consistently. My recommendation is this. Start by loading the indicator on your charts and just watching it for a week or two. Do not take any real trades yet. Just observe how the bands adapt, where the swing labels appear, and how price reacts to the signals. Get familiar with the visual language of the tool, then start paper trading the trend continuation strategy. Take every signal that meets the criteria and track your results. After you have a statistically significant sample, maybe 20 to 30 trades, review your performance. Are you hitting your risk-reward targets? What is your win rate? Where are you making mistakes? Once you are consistently profitable in paper trading, then and only then should you start trading with real money. And when you do, start small. Use the minimum position size you are comfortable with. Build your confidence gradually. As your results prove the edge, you can increase position size proportionally. Remember, trading is a marathon, not a sprint. The swing structure bands give you a clear framework for understanding market structure and timing entries. But your long-term success will come from discipline, patience, and continuous improvement. If you found this breakdown valuable, make sure to like this video and subscribe to the channel. I am constantly testing new indicators, strategies, and trading tools, and I share everything I learn with this community. Drop a comment below and let me know if you have used the swing structure bands before, or if you plan to test it out. I read every comment and love hearing about your experiences. Also, if there are other indicators you want me to break down in future videos, let me know. I am always looking for high-quality tools that can give traders a legitimate edge in the markets. Until next time, trade smart, manage your risk, and let the market structure guide your decisions. I will see you in the next video.